Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier sessions related to capital budgeting, we discussed about various techniques to be used for the investment decision making process, majorly NPV, IRR, profitability index, payback period, payback reciprocal, and discounted payback period. Now, let us solve some questions which are little bigger ones applying these techniques, and similar type of questions can very well be expected in the examinations. Let us see question number 7 in the ICA material at the end of the chapter. LA Private Limited is planning to invest in a machinery that would cost 1 lakh rupees at the beginning of year 1. Beginning of year 1 is nothing but year 0, that is now. Net cash inflows from operations have been estimated at 36,000 rupees per annum for 3 years. The company has two options for smooth functioning of the machinery. One is service and other one is replacement of the parts. So there are two options. Option 1, option 2. Option 1 is service. Option 2 is replacement of the parts after some time. If the company opts to service a part of the machinery at the end of year 1, timing is important, with a cost of 20,000 rupees. In such a case, scrap value at the end of year 3 for the machine will be 25,000. That is one option. Another option, however, if the company decides not to service the part, then it will have to be replaced at the end of year 2 at 30,800 rupees. Not the machine itself, but one of the major components or parts of the machine has to be replaced because it has not serviced the part in year 1. And when this replacement has to happen at the end of year 2, what is the cost of replacement? 30,800. And in this case, the machinery will work for 4th year also, because you replaced the part, now you have a new part, the machine will go for 1 more year. And get operational cash inflow of 36,000 rupees for the 4th year also. Next year, another year also, there will be operational cash inflow. It will have to be scrapped at the end of year 4 at 18,000 rupees. That is the option 2. Assuming cost of capital at 10%, ignoring taxes. When the question says ignore taxes, ignore taxes. Determine the purchase of this machinery, means determine the viability of the purchase of this machinery, we can call it, or advise whether the purchase of this machinery is good or bad for the company on the basis of net present value of its cash flows. NPV technique has to be used. And then the question continues, if the supplier gives a discount of 10,000 rupees for purchase, what would be your decision? So supplier of the machinery gives a discount of 10,000 rupees, means instead of 1 lakh, what if the supplier gives the machine for 90,000 only? Then what will be your decision? That we can come to it later. But first of all, let us calculate what are the options and what is the net present value of each of these options. Naturally, first thing first, we have to build the cash flows, and option 1 and option 2 separately we have to evaluate. So first let us look at option 1. What is option 1? Servicing the part at the end of year 1. So that has to happen. So we can just take the normal way of computation. Year cash flows, PVIF, discounted cash flows, that's enough. So year 0, 1, 2, 3. In option 1, only 3 years are there because the machine will work only for 3 years. That is given in option 1. So the initial investment is 1 lakh rupees. That is there. Zeroth year. Beginning of year 1 is nothing but now. That we have to understand. And net cash inflows from operations have been estimated at 36,000 rupees per annum. That is going to be same for each of the years. But in option 1, the servicing has to happen for the part of the machinery, one of the parts of the machinery, at end of year 1 at 20,000 rupees. So that means end of year 1, which is nothing but year 1, the cash inflows are 36,000, okay, but there is going to be an expenditure also in the form of 20,000, that is servicing the part of the machinery. So net cash inflows for end of year 1 will be only 16,000 instead of 36,000. But on the other side, in year 2, of course, 36,000 will come. In year 3, there will be scrap value, that is 25,000. We can do it separately also, or we can add it to the same 36,000 also. The cash flows are not exactly uniform. In year 1, there is some expenditure. In year 3, there is a scrap value. So different cash flows are accruing in each of the years. That is about the first choice, if the company opts to service the part of the machinery. Now coming to PVIFs, for year 0 it will be always 1 divided by 1.1, because 10% is the cost of capital. Then that divided by 1.1, that divided by 1.1. So 0.909826751, these are the PVIFs. Then multiply the cash flows with PVIFs and then total them. You do this on paper. Then the net present value in this case for this option 1 is negative 9872. So certainly it is not a good option. But what if the supplier gives a discount of 10,000? Because it is just going to be now, you can just add that to the NPV because there is not going to be any present value. So 10,000 discount means another benefit of 10,000 has come. Then the NPV will be around 128 rupees, which is a very nominal NPV. So that is the NPV in option 1. Normally it is negative. If the supplier gives a discount of 10,000, it will be positive, but that is 128 rupees only. That's about option 1. Let us not jump to conclusions without looking at option 2. Let us look at option 2 also. What is going to be option 2? Again, the cash flows and everything has to be calculated once again. Now, in option 2, of course, original investment is same, that is 1 lakh. Then 36,000 is same, that is not going to be different in option 2. But there is going to be one more year that is added. One more year is going to be added. So 4 years the machine will work. Now let us look at the cash flows. Servicing of the part is not happening at end of year 1. So first year's cash flows will be 36,000, no problem. But in year 2, servicing is not happening, but replacement is happening. At the end of year 2, 30,800 rupees will have to be spent for replacement of this part. So 36,000 will be their normal cash flows, but 30,800 will go in the form of replacement of the part. So net cash flows for year 2 will be only 5,200 rupees. Then third year will be same 36,000. Fourth year will be 36,000 normally anyway. Plus there is a scrap value of 18,000 at the end of year 4. So these are the actual cash flows for all the 4 years in case of option 2. Multiplying them with the respective present value interest rate factors, we got a NPV of 955 positive. And if the supplier gives 10,000 rupees discount for purchase, then the NPV is 10,955 rupees, which is good, which is positive and considerable amount also. Whereas in the first case, this is only 128 rupees NPV. So definitely option 2 is better than option 1. That can be the conclusion as asked in the question. That too when particularly the discount is given by the supplier of 10,000 rupees. Now a doubt might come, when the lives of these two are unequal, why can't we take equalized NPV? We can take, but it is not going to give any much difference. Why? Because the NPV here is very less. First of all, in the option 1, without discount and all, NPV is negative. How does it matter? Negative is negative. First of all, rule that out. That is no way comparable to any positive NPV. So obviously option 2 is preferable, irrespective of the fact that it is having 4 years time period. Even if we have to just blindly calculate equalized NPV, then also the decision will not change, because equalized NPV is nothing but whatever the NPV is there, that divided by annuity factor. So equalized NPV here will be still negative. Negative divided by anything will be negative only. What is going to be the difference there? Nothing. So still it is going to be negative only. Still any positive amount will be better than negative only. So it doesn't make any much of sense if we calculate equalized NPV. Even we take the annuity factor for 3 years in option 1 and 4 years in option 2. It doesn't matter. Here still it is positive. Whatever it is, but positive definitely yes. Here annual NPV negative is 4,000 almost. Here positive annual NPV is 300 almost. So which is still good. So option 2 is still better than option 2. Okay, let us take supplier's discount. Still doesn't matter. 128 rupees is not going to be a big deal. So annually the NPV that is going to be generated in option 1 is going to be around 51 rupees. That's all. But here the annual NPV that will be generated if supplier gives a discount of 10,000 rupees is going to be around 3496 rupees. So 3,500 rupees approximately is coming out to be the annualized NPV. Where is 50 rupees? Where is 3,400 rupees? Lot of difference is there. So in these cases, we can just understand this annualization is not required. Majorly more than NPV comparison, annualization and annualized equivalent cost is more important. So in other words, EAB, equivalent annualized cost or equivalent annualized benefit, in both of them, both are okay, both are conceptually correct, but more useful is equivalent annualized cost rather than benefit. So normally when there is a very narrow margin between one NPV and another NPV, that may be reasonable to do it, but one is negative, one is positive. So what is there to compare? Negative divided by anything also will be negative only. Positive divided by anything also will be positive only. So the decision will not change in this case. That is why there is no need to go with all those equalized NPV and all that. Not required in this particular case. So we cannot be rigid and we cannot say that I will have one procedure and I will follow the same procedure for any type of situation I will face. That will not work. We know that particularly in financial management, to some extent in costing in group 1 also, such approach will not work. It has to be case to case basis. As the question is given, we will have to approach it accordingly. Of course, here the PV factors are given in the examinations also. Generally they will be given. You take those PV factors. More or less the answer will be same. For 6 years they are given, which are useless. We need only up to 4 years. Enough. Sometimes unnecessary information will be given. You should be aware of that. That was question number 7. Now question number 8, I think we already did that. Then moving to question number 9 and 10, these are the bigger questions. 10 marks questions can be expected like that, and they were given also in the past examinations. 9 and 10 are possible models, if at all we want to call them models. Such type of questions can be expected for 10 marks. At a broader level, if we see in this chapter, possible questions. Okay, we are not setting the paper here, but what can be the possible questions? Of course, a 5 marks question is always possible with few calculations to be done, like the question number 1 at the end of the chapter, what we have done. Similar to that, 5 marks question can be expected, or only just for computation of NPV and IRR, just like that. Only some cash flows are already given. You are just supposed to compute NPV and IRR. Such kind of questions also can be given for 5 marks. However, because of the limitation of the financial management subject by itself, 10 marks questions are more commonly asked from this chapter, because just if you observe the paper, we need 60 marks and certainly at least 2 to 3 10 marks questions we need. That means the paper setter has to set 2 minimum 3. Generally on an average 3 questions of 10 marks have to be given. All other chapters are there which are generally for 5 marks only. There is no scope for them for 10 marks, like leverages, like dividend policies. So such kind of chapters like risk in capital budgeting, those are all 5 marks type of chapters only, where from the 10 marks questions will come. 10 marks questions, one question definitely working capital management, Another question possibly from investment decision making, which is capital budgeting. Another question can range or change between ratio analysis and cost of capital, capital structure. So almost we can say 10 marks question is guaranteed from this chapter, because this chapter has the scope. All chapters do not have a proper scope of asking a 10 marks question. They can be framed, they can be fabricated separately and designed, but normally on a regular basis, if we see the past papers, most of the cases 10 marks questions will come from, guaranteed 10 marks questions will come from two chapters. One is working capital management, two is capital budgeting. These are guaranteed 10 marks questions almost every paper. Exceptions will be always there. So that is the reason 10 marks questions in capital budgeting are quite common, and such kind of questions can also be asked in multiple ways. What type of questions were asked earlier? Asking too many calculations. For example, all techniques are asked. NPV you have to calculate, IRR you have to calculate, okay, and profitability index you have to calculate, payback period or discounted payback period you have to calculate. So many techniques are asked on the same set of data. So it is only just application of techniques. Data is there almost readily available. Data means basically cash flows and other required information. That is one type of question where techniques are only just applied more or less mechanically, because once you practice more, these things will be regularly easier to just apply. But better than that, and actually the real testing happens when cash flows are not given. So the major chunk of the question is for you to build the cash flows. Application of the technique is going to be a secondary thing. That can be any of them. Generally that will be NPV for selection criteria, since NPV is a better technique. So application of the technique is going to be playing a smaller role. Building of cash flows is going to play a bigger role. Such kind of questions are also given, were also given, can be given. So at a broader level, if you see, some questions are there where the information is readily available. All that is tested from you is whether you know the technique and application of the technique or not. That is more clerical, but still marks are marks. If you do solve the questions accurately, you will get full marks there. But the real test for the brain, whether you can build the cash flows or not, will come in the second category of questions. That is the category of questions we are looking at in question number 9 and 10. So here, building up of the cash flows itself is the crucial part. So what is required there? Serious observation of data, nothing else. And two factors always to be kept in mind. One is amount of cash flow, two is direction of cash flows, three is timing of cash flows actually. So amount, direction and timing. If these three are carefully observed, then we can build the cash flows. Carefully build the cash flows, carefully estimate the cash flows. Application, you should not be very worried about or to be hurried about the actual calculation of NPV. More care has to be taken, because in these type of questions, marks also will be awarded for estimation of cash flows more. If that is wrong, what is the risk in these questions is, imagine if the cash flow calculation is wrong, NPV will be naturally wrong, right? So total question is gone. So your application is going to be depending upon your first calculation, that is cash flows calculation. So such kind of questions can be expected for 10 marks. Very, very crucial. Should be definitely able to solve such questions comfortably. Let us look at this 9th question. XYZ Limited is planning to introduce a new product with a project life of 8 years. That is the total life of the project. First point. Second, initial equipment cost is going to be 3.5 crores. 3.5 crores. So crores to lakhs, these conversions we should be able to do comfortably. So if at all we take in lakhs, if at all, we can take 3.5 crores as 350 lakhs. That is the amount of investment. Additional equipment costing 25 lakhs will be purchased at the end of third year from the cash inflow of this year, whatever. At the end of 8 years, the original equipment will have no resale value. So this 350 lakhs worth of equipment, which has a life of 8 years, will not have any resale value. So that is zero scrap value at the end of the 8th year. But The additional equipment which was purchased when, timing is important, when that was purchased at the end of third year, then onwards only there will be depreciation, right? So for that machine of 25 lakhs which was purchased at third year, end of third year, that will be possibly sold at 2,50,000 at the end of its life. That is total project life 8th year. And an additional working capital of 40 lakhs will be needed and it will be released at the end of 8th year. We know this treatment of it. Working capital, additional working capital requirement should be initially treated as an outflow and later it should be treated as an inflow at the end of the life of the project, which will be released. The project will be financed with sufficient amount of equity capital. That's okay. Financing part, we don't need to worry. We are only interested in the investment part. The sales volumes over 8 years have been estimated as follows. Okay. Sales volumes, these are, means number of units, 72,000 units, 1,08,000 units, like that. For 3 years they are given separately. 4 to 5 means 4 and 5. Both years number of units will be 2,70,000 each. 6 to 8 means 6, 7 and 8. For all the 3 years number of units is going to be 1,80,000 units. A sales price of 240 rupees per unit is expected. Variable expenses will amount to 60% of sales revenue. So that naturally PV ratio is 40%. Directly we can calculate contribution per unit and then multiply with the number of units so that we can get total contribution in each of the years. Alternatively, if you want to show little detailed manner, we can show sales first, then deduct variable cost, then show contribution, then fixed cost, etc., etc. So fixed, read this word carefully. Cash operating cost. Cash operating cost means what? Other than depreciation. That will amount to 36 lakhs per year. That is fixed cash operating cost. Depreciation is different. That is in addition to this cost. The loss of any year will be set off from the profits of subsequent 2 years. Normally, again, we don't have to apply the Income Tax Act here of India. Whatever is given in the question, that has to be applied. If nothing is given, you can take an assumption. Normally, when there is a loss of 1 year, it can be generally carried forward for a period of 8 years as per Income Tax Act of India. But we don't care. As per this question, it says if there is any loss in one of the years, of course, there will not be any tax liability of that year. However, that loss of 1 year can be carried forward and set off in the next 2 years. That is given in the question. Company is subject to 30% tax rate and considers 12% to be the appropriate after tax cost of capital for this project. So discount rate is 12%. That is the essence of this. And the company follows straight line method of depreciation. That saves time. Of course, if it is depreciation charged on WDV method, nothing will happen. It will require one more working note for computation of depreciation using WDV method. That is the only thing. Now, what is required here is to calculate the NPV of the project and advise the management to take appropriate decision. Means, should it go ahead with this project or not? Perfect question. So, all that we need to do is, first thing first, build up the cash flows for 8 years. After that, it is all just discounting with this 12% rates so that we get NPV. What is there? So, the main point is building up of the cash flows. So, let us look at the cash flow calculation. First of all, naturally, there should be a proper heading. Statement showing computation of cash flows during the life of the project, or just statement showing computation of cash flows. That is enough. So, what are the years? We can do this horizontally so that we can have many items here, because there might be some plus minus, all of them can be taken out easily so that the total of the net of the cash flows in each year can be easily calculated. So, cash flow calculation, do it horizontally. NPV calculation, do it vertically. Because in NPV calculation, there are not going to be any more columns. There are going to be only these columns. Here, cash flows, PVIF, DCF. There ends the matter. But cash flows, there can be many rows. So, better to do it horizontally here. So, 0th year, year 1, year 2, year 3, year 4 to 5, we can directly say 4 and 5, let us call it 4 and 5. Okay. Then 6, 7 and 8. 6, 7 and 8. We are calculating cash flows only. For cash flows, we can directly calculate for both the years. Of course, for 8th year separately, we have to calculate another aspect. Because in 8th year, there might be some terminal cash flows separately. We will take that separately. Or let us do this way. It is easier. 6 and 7 separately we will take. And 8th year separately we will take. That's better. So cash flows 0, 1, 2, 3, 4 and 5, 6 and 7, 8. These are the cash flows to be developed. Now look at the data, and one by one all that you need to do is fill in the overall table like this, as if it is a cash flow table, right? So let's start. One by one. So what is the initial equipment cost? 3.5 crores. All rupees in lakhs, it is easier to take. Rupees in lakhs. But you have to clearly write that on the top right hand corner. Rupees in lakhs. That has to be written on the top right hand corner. Okay. So let us take rupees in lakhs. So initial investment, initial cash outlay, or purchase price of machine, whatever. Descriptions can be just according to our convenience. So the purchase price of the machine, initial equipment cost, whatever you write it, that is going to happen in year 0. How many lakhs it is going to be? Minus 350 lakhs. It has to be also clear when we are looking at the cash flows. Minus and plus is important because it is a cost, it is an outflow. Minus 350 lakhs. 3.5 crores. Each crore is 100 lakhs. So 350 lakhs is going to be the initial equipment purchase cost. Additional equipment costing 25 lakhs will be purchased at the end of 3rd year. So 3rd year also there is purchase of machinery. Additional. But that is how much? That is going to be 25 lakhs. So minus 25 because we have all rupees in lakhs. That is going to happen end of 3rd year. And at the end of 8 years, the original equipment will not have any resale value. But additional equipment can be sold for 2,50,000. As the information is there, we can take plus minus whatever it is. So let us call it scrap value, salvage value, scrap value. At the end of the life, 8th year only it will come. That is going to be an inflow. 2,50,000 means 2.5 lakhs positive. That happens at the end of 8th year. Then working capital. Working capital requirement of 40 lakhs will be needed initially, which will be released at the end of 8th year. So 40 minus in year 0 and 40 plus in year 8. That is the treatment for working capital. Blocked and released. Then project will be financed with sufficient amount of equity capital. That's okay. Next comes the sales volume over 8 years have been estimated as follows. So here we can do another working note, only computing what are the actual cash flows for the project, cash inflows for the project. So same continuation of the table, we can do it another working note. Same way. Here, as I said, according to the time available, you can have sales separately, then variable cost separately, then contribution, all are okay. But there is no need of all of that. So straight away, let us calculate contribution. Contribution. Of course, in year 0, nothing will be there. There is no contribution. Year 0, because there is no sales, first of all. Now, what is contribution per unit? That can be shown in another working note also, small working note. Because selling price is 240 rupees. Variable expenses are 60% of sales. Contribution will be 40% of this. So 240 into 40% means 96 rupees is the contribution per unit. Per unit. Like that, how many units are there? You just have to multiply that. So 96 multiplied with 72,000. We'll take the lakhs, all of them later once we calculated this. So contribution, because waste of time, again everything to divided by lakh, can be done also, no, not a problem, but let us do it first of all total things in full amounts. Here we can take them in lakhs in the main calculation. Alternatively, we can do everything in lakhs also. This is our choice. So let us take in lakhs so that there will be consistency, no problem. So divided by 1 lakh means it gives lakhs, whatever the contribution in lakhs. So 72,000 units multiplied with 96 rupees per unit divided by 1 lakh means 69.12 lakhs is going to be the contribution in year 1. Like that for year 2, same way. 1,08,000 units, but so instead of 72,000 units, 1,08,000 units, 103.68. Then 2,60,000 units, year 3, 2,60,000 units, now 249.6. 4 and 5 are going to be same, that is 270,000 units. So contribution is that much. 6 and 7 are also going to be same, but number of units will be reduced to 1,80,000 units. So 1,80,000 into 96 divided by 1 lakh, that much. 8th also will be same. 8th also will be same. That is a contribution. Because 8th year also there will be sales. 1,80,000 multiplied with 96 divided by 1 lakh. Because we are calculating everything rupees in lakhs. So that is a contribution in lakhs. From that, deduct fixed costs. Fixed cost, cash, let us call it cash operating fixed cost. Here 0 of course will be none. All these things will not have anything in year 0. We don't need that also actually. You can start directly from year 1. So cash operating fixed cost will be 36 lakhs per year. That is going to be same. So minus 36. Each year it will be minus 36 only. Cash operating fixed cost. Copy paste on paper. That is the fixed cost. But depreciation is also there, which has to be calculated on straight line method. So important point here, depreciation. Depreciation on the original equipment. First let us calculate 350 divided by 8 directly. 350 divided by 8. So 43.75 lakhs. 43.75 lakhs is going to be the original depreciation on the original equipment. That was 350 lakhs, 8 years. That is one thing. Now depreciation on the additional equipment. Additional depreciation here does not mean Income Tax Act additional depreciation. Depreciation on the additional equipment which is purchased at the end of year 3. So year 1 there will not be anything. Year 2 there will not be anything. Year 3, end of year 3 this is purchased. Which one? This additional equipment of 25 lakhs. So year 3 also there will not be any depreciation because end of year 3 it was purchased. It starts from year 4 onwards. How much will be the depreciation? 25 lakhs is the purchase price minus scrap value, that is 2,50,000 at the end of year 8. How many years is still there? 4, 5, 6, 7, 8. Only 5 years. So 22,50,000 divided by 5. Each year it is going to be in lakhs 4.5 lakhs. So minus 4.5 lakhs, 4.5 lakhs, 4.5 lakhs. 25 lakhs minus 2,50,000 divided by 5 only, because the remaining life is only 5 years. 4th, 5th, 6th, 7th and 8th year, that's all. So the additional depreciation or depreciation on the additional equipment will be 4.5 lakhs each year starting from 4th year onwards. That is the other point to be noted. I think these are the main things. naturally for the computation of profit. So let us calculate first of all profit before tax. Profit before tax. So what is going to be the profit before tax? Contribution minus cash operating fixed cost minus depreciation and minus additional depreciation if any. So this is the profit before tax, which is 10.63 lakhs negative in year 1. What about year 2? Same way. If you calculate, you have to do these calculations for each of the years. So the profit before tax is going to be like this: 10.63, 23.93, 169.85, etc. All these calculations are to be done. That will take time. That is why 10 marks. 10 marks will not come just like that. Of course, such questions will take some time. Quicker you do the calculations, it will be better. So that is the profit before tax for each of these 8 years. Now let us deduct tax. For year 0, it will be now no tax because there is loss. When there is loss, we don't have to pay any tax. But carefully calculate for year 1. Year 1 is no tax. Year 2, there will be tax. But how much will that be? That has to be calculated carefully. 23.93 is the profit. On that, you can set off 10.63 because there is a loss in year 1. So net profit taxable for year 2 will be only 13.3. On that, 30% tax rate is there. 30% tax rate is given. So 3.99 only is going to be the tax for year 2. That is one calculation which is important. How? 23.93 set off 10.63 on the remaining 30%. That will be the tax only for year 2. Year 3 onwards, it is directly whatever the profits are there on that 30%. There is no problem for other years. You can take 2 decimals, that is enough. Don't worry about more decimals. 2 decimals are generally enough. So this is a tax. But of course, this has to be negative in the sense for our calculation, which are supposed to be in bracket. That means tax has to be deducted. Now, what is profit after tax? Profit after tax here is still negative because this plus 0 is still negative. Profit after tax also. Here profit after tax is positive 23.93 minus 3.99. Then profit after tax for each of the years can be calculated like that. Taking profit before tax minus tax. Next, cash flows when we want the cash flows, annual cash flows. So annual cash flows will be how much? Whatever the profit after tax is there plus depreciation. In this case I am doing minus because already it was minus. So minus of minus will be plus. So you have to do plus there. That means minus 10.63 plus 43.75. Same way. 19.94 plus 43.75. Same way. 118.9 plus 43.75. Be careful for the remaining years because here you need to also add the depreciation on additional equipment, which is 4.5 lakhs. So 170.2, then 110.24, then again 110.24 will be the annual cash flows for each of the years. So these things can be directly taken into the table that we originally have where we are building the cash flows. These are the annual cash flows starting from year 1 onwards. So annual cash inflows, let us call them, are this much. Year 1, 2, 3, 4, 4 and 5, 6 and 7 and 8. And working capital treatment already done. Scrap value for the additional equipment already done. And original equipment purchase is already done. So all that we need to do is finally what are the net cash flows for each of the years. That is nothing but the sum of all these things simply. So for year 0 it is going to be 390 lakhs. For year 1 it is going to be 33.12. For year 2 it is going to be same. For year 3 it will be less than 162.25 because there is a negative cash flow or outflow of 25 lakhs. For year 4 and 5 it will be same. For year 6 and 7 it will be same. Again for year 8 it will be different. because of release of working capital and scrap value in year 8. Now we have the cash flows which are there as net cash flows for each of the years. Right? Now comes the actual calculation for NPV. Here we have to take all the years. Here cash flows, PVIF and discounted cash flows. Here 0, 1, 2, like that. Each year separately has to be taken. 4 and 5, 6 and 7, 7 and 8 cannot be taken. Why? Because discount factor for each of the years is different. Even though the cash flows for, let us say, year, not here, yeah, the net cash flows for year 6 and 7 are same, year 4 and 5 are same, but discount factor will not be same, right? So naturally they have to be taken separately, no option. So year 0, what is going to be the cash flow? Straight away this has to be taken, that is 390 negative. Year 1, you have to write that from the first table, main table, net cash flows 33.12. Then what about year 2? 63.69. Year 3, 137.65. Year 4 and 5 will be same, that is 170.72. It will be same for year 5 also. Year 6 and 7 will be same, that is 110. Incidentally same. So 170.72, 110.24. But year 8 again will be different. Year 7 will be same. Year 8 will be different. How much is that? We calculated 152.74. So once you take that, PVIFs can be taken. 12% is the discount rate. In exam you can directly take from this table to save time. I am just taking easily 1 divided by 1.12, 1 divided by 1.12, that divided by 1.12, and so on. Simple. So these can be taken from tables for your convenience. For you, taking from tables is convenient. On computer, calculation is convenient. That is the difference. Now discounted cash flows, simply multiply. No, here it will be 1. PVIF for year 0 will be 1. So this will be 1 multiplied with minus 390, and multiply each of the year's cash flows with the respective PVIFs, then total them. So NPV of this project is going to be 161.08 lakhs, around 161 lakhs we can call it, which is positive, and definitely a considerable amount of NPV is there. So what will be the advice? Appropriate decision. What will be the appropriate decision? Definitely to accept this project, since NPV of the project is positive. That last conclusion will get 1 mark. You cannot leave that, you cannot just like that only show calculations and think that the solution is over. So this is the final solution for this. On paper, definitely it will take little more time, natural, but with practice you can reduce the time that is taken for such calculations. Accuracy is again important, so be careful what buttons you are pressing on the calculator. That's it. That is question number 9, a perfectly possible 10 marks question. That is question number 9. Just for clarification, in the essay material, the solution is little wrong because they forgot to take the scrap value of the additional equipment at the end of 8th year. Because of that, there is a slight difference. Our calculation is correct. So NPV of this project is approximately 161 lakhs, we can say. Now, moving on to question number 10. A large profit-making company is considering the installation of a machine to process the waste produced by one of its existing manufacturing process to be converted into a marketable product. All this story just for general understanding. Already it is a profit-making company and it wants to install a machine for what? Waste management, basically, so that the waste can be converted to some marketable product. Like for example, molasses can be converted to alcohol, something like that. At present, the waste is removed by a contractor for disposal on payment by the company of 150 lakhs rupees per annum for the next 4 years. So that means the company is not making any money On other side, it is incurring cost because of this waste disposal, where it has to pay. Already it has a contract with some contractor where it has to pay 150 lakhs per annum. Now, point we have to understand is, once we have our own waste management system and this machine, this contract need not be there, which means we can save 150 lakhs. The company can save 150 lakhs each year. The contract can be terminated upon installation of the aforesaid machine on a payment of compensation of 90 lakhs rupees before the processing operation starts. That means year 0, now we have to pay the contractor 90 lakhs rupees because we are terminating a contract. According to the terms of that contract, we have to pay 90 lakhs. That is an outflow. So that is an outflow of 90 lakhs rupees now, and there is an inflow or a benefit of 150 lakhs rupees each year for the next 4 years because of this contract. And very clearly it is given that the compensation is not allowed as deduction for tax purposes. This is termination of contract, whatever it is. Again, we don't have to apply our income tax knowledge. So whatever is given in the question, we have to take that. It is not allowed means not allowed. 90 lakhs rupees is not having any tax impact. It is just like a part of initial cash outlay, we can call it, because it is a outflow in year 0. The machine required for carrying out the processing will cost 600 lakhs rupees to be financed by a loan repayable in 4 equal installments commencing from the end of year 1. The interest rate is 14% per annum, and at the end of 4th year, the machine can be sold for 60 lakhs rupees. Cost of dismantling and removal will be 45 lakhs rupees. So scrap value effectively will be how much? Because you can sell it at 60 lakhs, but dismantling and removal itself is costing 45 lakhs, which means effectively you are getting an inflow of only 15 lakhs. When is that? At the end of 4th year, that is the life of the project. Sales and direct costs of the product emerging from waste processing for 4 years are estimated as under. Of course, before going to these things, main point here is there is a loan that is going to be taken by the company for the purpose of this machine, particularly for the purpose of this machine. See, normally when you say, when there is a financing that is done, generally for the company as a whole, we have the cost of capital. Anyway, we are using that, so we ignore the interest and we ignore the installment amounts also. But this particular situation is in such a way where the loan is taken separately. There is no outflow. Actually, machine is not going to be purchased initially with the payment of 600 lakhs. So outflow itself will happen in the form of loan. So that is already going to be financed. So one way you can consider as if like we are taking this machine on finance. So outflow is not happening in year 0. It is happening in year 1, 2, 3, 4 in installments. So outflow is not one shot. It is in installments. That is a point to be noted. And another point to be noted is there is interest cost also which is associated with this. So as good as, though it is not really that, but as good as a kind of hire purchase situation where you have to pay the installments and interest also. Under normal circumstances, when the initial cash outlay already is there, we ignore the finance cost. That is different. But in this particular case, we cannot ignore that. Why? Because the amount is not paid now. It is going to be paid in 4 installments. Of course, interest also has to be paid. So total installment we can consider as the cash outflow. But again, there is a problem in that because interest has a tax deduction, whereas installment will not have a tax deduction. So we have to segregate them. That working notes has to be done separately. End of the 4th year, scrap value is a simple point. 60 lakhs inflow, 45 lakhs outflow. The sales and direct cost of product emerging from waste process are given. So these things are directly, we can take them. Sales and material consumption, wages and other expenses are all given for 4 years, all rupees in lakhs. Factory overheads are also given. Depreciation as per income tax rules is already given. So we are happy. We don't need to calculate depreciation. Already it is given in accordance with the income tax rules so that we can automatically take it. Depreciation is relevant for our analysis only for tax purposes. So that is relevant. Income tax rules wise, whatever depreciation is, that is more relevant. Then another further information is given like initial stock of materials required before commencement of the processing operations is 60 lakhs at the start of year 1. So additional material requirement is there at the start of year 1. Start of year 1 means year 0. The stock levels of materials to be maintained at the end of year 1, 2, 3 will be 165 lakhs. So additional material required in year 2 will be how much? 105 lakhs because already 60 lakhs is there at the beginning of year 1. So End of year 1 you need 165 lakhs means 105 lakhs has to be blocked at the end of year 1, and same amount has to be released at the end of 4th year, including the original 60 lakhs. So it's a kind of working capital requirement only, but given in the different form, in the form of materials stock, which is a part of the working capital requirements. And stocks at the end of year 4 will be nil, which means the entire 165 lakhs will be released at the end of year 4. And also another information is given that the storage of materials will utilize the space which would otherwise have been rented for 30 lakhs rupees per annum. So already we would have rented this space, this material storage where we are using this. It could have been rented for 30 lakhs rupees per annum, which we are losing now. So certainly there is going to be a opportunity cost here, that is 30 lakhs rupees per annum. Then labor cost includes wages of 40 workers whose transfer to this process will reduce idle time payments of 45 lakhs in year 1 and 30 lakhs in year 2. So there is going to be a reduction in the wages cost as given in the question. Year 1 45 lakhs will be reduced. Year 2 there will be a benefit of 30 lakhs in the form of wages because of reduction in idle time. Factory overheads include apportionment of general factory overheads except to the extent of insurance charges of 90 lakhs. See, apportionment of general factory overheads should not be taken as part of cash flows. We discussed that because it is not a relevant cost. It is not particularly related to this project. It is general factory overheads incurred throughout the factory. So that is irrelevant for this project. But except to the extent of 90 lakhs it is mentioned. That means 90 lakhs is relevant. That is payable related to this venture only. And tax rate is 30%. Present value factors are given. Advise the management on the desirability of installing the machine for processing the waste. All calculations should form part of the answer. So similar question like the earlier one. But again, little bit more information is given in the form of various savings, additional costs, that, this, etc. So all of them have to be incorporated. So naturally, building of cash flows is going to be the crucial part even now, even in this question. So let us do that first. Then we can move on to computation of NPV is nothing. Cash flows just multiply with these factors. You got the discounted cash flows, total them, you got NPV. So that's not a big deal. Building the cash flows is the main point here. So let us take the cash flows first as a working note. Then we will see the annual cash flows from the operations. That also we will incorporate. So statement showing computation of cash flows for the 4 years period. So let us look at them one by one. So 0th year, year 1, year 2, year 3 and year 4. Main point here to also notice which of the items are related to tax, which have tax impact, which do not have tax impact. In other words, which are revenue items, which are capital items also should be noted. Capital items directly we can take here itself, whereas revenue items which have tax impact we can calculate separately, wherein we can compute profit after tax and then we can add the depreciation to get net cash flows for each year. Now look at the data one by one. First thing first, contractor payment 150 lakhs is going to be a periodic saving. So when there is a saving on this 150 lakhs, there is going to be a tax benefit lost also. So there is definitely a tax deduction on 150 lakhs which we might be already claiming that will be lost. So the net benefit will not be 150 lakhs, it will be less than that. So we'll include it as part of the cash flows which have tax impact. So that 150 lakhs we will wait because it is a periodic annual cash flow. But initial cash outflow, how much here? Payment of compensation for which there is no tax deduction at all as given in the question. There is no tax deduction at all for this compensation that is going to be paid, all rupees in lakhs. So that is how much? 90 lakhs. Separately you can write it. Compensation, contractors, compensation. Contractors compensation how much? 90 lakhs. That is not having any deduction for tax purposes. So it is an outflow in year 0. That is one thing. Then cost will be 600 lakhs. We are not paying that. We are not paying that. We are paying in 4 equal installments. So installment amount is not going to be definitely tax deductible. That is going to be a capital item. But it is not happening in year 0. 4 equal installment commencing from the end of year 1. 4 equal installments, 600 lakhs is going to be paid. 600 divided by 4. That means 150 lakhs each year has to be paid. 150, 150, 150, 150. Not in one shot. It is happening in 4 equal installments. That is one point. Interest is related to tax. So we will compute interest and do the calculations of profit later on separately. At the end of 4th year, machine can be sold for 60 lakhs and cost of dismantling and removal will be 45 lakhs. So let us call this as salvage value or scrap value. When is this going to happen? At the end of 4th year. Effectively 15 lakhs only. Why? Because 60 lakhs sale value, cost is 45. Effectively 15 lakhs only is going to be the net cash inflow in the form of scrap value at the end of 4th year. Then comes the operational details, sales and direct costs. So all of them can be done separately in a working note. Here 0 will not be there here. Starting from year 1, there will be various items. All that you need to do is take the copy paste the amounts. Sales 966, 966 all lakhs, 1254, 1254 all lakhs. Material consumption. Material consumption. Is there any amount related to the material consumption? Consumption is different. Requirement of materials as working capital, extra materials is different. So that is a different story. But storage is going to have an impact later. We will come to it later. But this is a normal material consumption which has to be taken as it is. There is not going to be any difference. So 90, 120. Of course, this is minus 90, minus 120, minus 255, minus 255. Material consumption. Then comes wages. Wages is given in the question, but at the same time, for the first 2 years, there is going to be a saving in the wages. So labor cost include wages of 40 workers whose transfer to this process will reduce the idle time payment of 45 lakhs in year 1, 30 lakhs in year 2, only 2 years. There is going to be a saving in wages. So it is not going to be 225 lakhs. It will be less than that. So how much will that be? 225 minus 45. Because first year saving will be 45 lakhs. So minus 180 only will be wages in first year. Then 30 lakhs saving will be there in the second year. Normally wages are 225. 30 lakhs savings means only 195 will be the wages in second year. Third and fourth year it is going to be same as given in the question. So minus 255 and minus 300. Nothing different in that case. That is wages. Then there are other expenses. Other expenses are nothing mentioned about them. So just copy paste 120 minus 120, 135, 162, 210. That is other expenses. Right? Then comes factory overheads. Factory overheads, there is another information given. There is an inclusion of apportioned overheads also here, which should not be taken into considerations as they are irrelevant for decision making. To what extent they will be relevant? Only 90 lakhs rupees which is payable for this venture. Only that will be relevant. So 90 lakhs rupees is only going to be relevant. So that is 90. Then that is the factory overheads, but it should not be taken as 165, 180, etc. No. Then comes depreciation as per income tax rules. Already given. All that we need to take is directly copy paste. 150, 114, 150, 114, 84, 63, 84, 63. That is depreciation. So these are the various items which are there having normal operational results. In addition to this, there are certain things which have tax impact. Either we can just calculate profit after tax and then take the after tax result of those additional items, or we can just take all of them also as part of it. Ultimately the result will be same. So let us take the other items also which have tax impact. What is one thing which has tax impact for sure? That is 150 lakhs extra cost that is going to be incurred. Oh, sorry, 150 lakhs saving, not extra cost. Already we are incurring that. in the form of paying to a contractor, there will be a saving of 150 lakhs. That will have a tax impact. So when there is a saving that is positive 150 lakhs each year, there will be saving. Next, 90 lakhs already we have taken up, and installment amount we already took. But what about interest amount? Interest, we have to just consider here as if it is like a normal monthly installment or annual installment, like in the case of hire purchase, because this is only for the purpose of this project. This has got nothing to do with the general company financing. That is different. So this is only purely financed for the purpose of this project only. So certainly we should take interest cost also. That is the 14% per annum. This can be calculated separately because the loan amount is going to be how much? Originally 600 lakhs. At the end of first year, it will be 150 lakhs which is paid. So first year there will be 14% interest. That is 84 lakhs. Interest is cost. Then end of second year, it will not be 600 lakhs outstanding. Already 150 principal amount is paid. Remaining is 450. On that 14% means 63 lakhs will be the interest amount minus 63. What about third year? Again, what is outstanding amount? Principal amount 600 minus 300, already 300 paid. Remaining on that 14% is 42 lakhs will be the interest. Then at the end of fourth year, already 600 minus 450 would have been paid. Only 150 lakhs is still remaining. On that 14% means 21 lakhs will be the interest. So this interest calculation can also be shown separately in the working note. If time is not available, you can directly write the interest amounts also. But it has a tax impact for sure. So that is taken up before tax. Sales and direct expenses, all of them are taken. The stock of materials and all will not have tax impact. That is only a working capital requirement. So stock of raw materials or additional working capital requirements, we can call it. Start of year 1, there will be 60 lakhs. So minus 60 in year 0. We are not doing it in the operational thing. We are doing it in the original main cash flows calculation. So stock of raw materials extra, additional stock of raw materials you can call it, or additional working capital requirements also you can call it, minus 60. But at the end of year 1, 2, 3, it should be 165. So how much extra is required in year 1? Only 105. And year 2 and 3, nothing extra will be required because already 105 and plus 60, 165 is there. It will continue to be same. Means opening stock, closing stock will be same. But at the end of year 4, it will be nil. Means what? Entire 165 lakhs will be released. So it will be a positive cash flow. So year 0, year 1, it is negative. In year 4, it is positive. That is a release of working capital in the form of stock of raw materials. Then another information is given in the question. The storage of materials will utilize the space which would otherwise have been rented out for 30 lakhs per annum. Means already we would have been earning that money. That also has tax impact because there is a rental income and it is a company with normally a lot of other operations also. The starting of the question itself says it's a large profit making company. This is only just one part of that big company. So that 30 lakhs will have a tax impact. So that 30 lakhs is what now we are losing it. It is an opportunity cost, but it is not really an opportunity cost also. Conceptually opportunity cost. Is the company losing that 30 lakhs? Yes. To that extent. Is there a tax benefit? Yes. To that extent there will be. So that also has a tax impact. How much is that? So rent foregone we can call it. Rent foregone. Again I am reminding, conceptually it is opportunity cost, but it is not something unreal. It is already being earned. But because of this, that income is gone. So to that extent there is a loss, there is a cost involved. How much is that? 30 lakhs. That can be taken in each of the years also. That is rent foregone in real terms. Really also it is foregone, not just imagination. That is one thing. Labor cost already we did, and insurance also already we have taken, factory overheads, everything else is taken. I think that's all. These are the various items which are given in the question. All of them have been taken up. Now let us take all these things to be carefully totaled. And what is the resultant is profit before tax. Need to do these calculations. Profit before tax. Just make sure plus and minus are there correctly. Sales is plus, material consumption is minus, wages is minus, other expenses are minus, factory overheads are minus, depreciation is minus, saving is plus, interest is minus, rent foregone is a loss or an opportunity cost, so it is minus. So it is not a benefit, it is cost. That's it. This is profit before tax. Then deduct tax. How much tax? It is given as tax rate 30%, I think. Yeah, 30%. So take 30% of this. Do the calculations. 30% tax. After that, what will be the remaining? Profit after tax. What is profit after tax here now? Profit before tax minus tax. So that is profit after tax. But that is not the cash flows. Net annual cash flows will be how much? Net annual cash flows will be profit after tax plus depreciation. Since already it is taken as minus here, I am taking minus, but it should be add back depreciation. So how much will be the net annual cash flows for each of the years? This much: 410, 372, 424, 367. Now we got our final answer, final cash flows number. That can be substituted here, where net annual cash flows can be taken, and we have the cash flows for each of the years, which can be simply discounted. Total them: year 1, year 2, year 3, year 4, and year 0 also. So these are the various things. All items are taken. Any item missed, naturally will give wrong answer. So every item has to be carefully treated at some place. Now all the things, if taken up correctly, this will be the net annual cash flows which are supposed to be discounted. So let us take them and calculate the NPV. So we have the net annual cash flows already here. This is cash flows. Then we have PVIF. Then discounted cash flows. Year 0, 1, 2, 3, 4. 4 years only are there. Then PVIF percentage is given as 14%. So of course this will be 1. 1 divided by 1.14. That divided by 1.14. That divided by 1.14. That divided by 1.14. So these are the PVIFs. 0.877, 769, 675, or 4, or 592, whatever. Then multiply the cash flows what we already calculated with these PVIFs and simply total them in order to get what is the total net present value of this particular project. Approximately that comes to 578 lakhs. That is the net present value, which is positive. So yeah, approximately that is the net present value, 578 lakhs. There will be a difference. That doesn't matter. That's okay. So if it is very close to that, that's fine. So since the project is having positive NPV, certainly this project can be accepted, and this is a feasible project, we can call it. So that is question number 10. And main point, already what we discussed are given as notes here. Material stock increases are taken as cash flows because as additional working capital requirement. Idle time wages are also considered separately. Apportioned factory overheads are not relevant. Only insurance charges of 90 lakhs are relevant. Interest is calculated 14% on 4 equal installments, which normally will not be done in other cases. Only in this particular problem it is done like that because of the specific case of loan and installment, not a initial cash outlay. Then sale of machinery is taken after deducting the removal expenses, and capital gains on the tax on the capital gains on the sale of machinery is ignored. That is a convenient working note we can write. So that is one more point. Then sixth point is saving in the contract payment, and income tax on that also is considered as cash flow because it is not completely an imaginary cost. Though it is an opportunity cost, it is a real saving. On one side it is a gain, and on the other side the material space that is foregone. Both of them are not imaginary, they are real. That is why they have tax impact. Normally speaking, technically opportunity cost will not have any tax impact, but here Since they are real cash flows, they have tax impact. That is another point to be noted. With that, we can conclude all the crucial and important problems which are there in the ICA material. These are the types of questions normally we can expect, and there are some small other topics also, like average rate of return or accounting rate of return, MIRR, and replacement decisions is one more small topic, important though, and capital rationing. These are the four other things which are miscellaneous things we can call. All those things we'll discuss in the next session and conclude this chapter. But again, so far whatever the discussion happened in this chapter of capital budgeting is what mainly is important from the examination point of view. In the next session, whatever we are going to discuss, replacement will be important, but remaining things are small things. That does not mean they are not important. ARR is a simple formula. MIRR is just a modification of IRR technique. And capital rationing is a concept. Questions are given on that also earlier, but we can just simply understand them quickly. The only main point, if at all, for a bigger question which is remaining is replacement decisions. That also we will discuss in the next session and conclude this topic of capital budgeting. But once again, I would like to remind you that you need to practice these things on paper with the proper calculations. Then only you will be able to solve these questions quickly and accurately in the examination. Lot of practice is required. Just knowing how to do is not enough. That is not going to give you marks in the main examination. Let us be clear on that. Fine. We'll again discuss the remaining topics of this chapter in the next session. Till then, take care. Bye-bye. Thank you very much.